Hey guys, how are you all doing on this fine day today? We had some really crazy developments happen today that if you aren't aware of, you should be creaming in a moment when I go over them. Today's segment will be about discussing swaps a little more in detail. This is all theory-based, as we unfortunately don't have any real information that discloses real positions or transactions between some of the different entities we will bring up. However, everything here is based on previous historical patterns that have lined up and been followed for decades. As such, I believe much of what we will discuss should hold true. We have talked in length about some of this stuff before, but I have not really put it together cohesively in a manner that makes sense and is easily understood for smooth brain operators such as yourselves. Today, we are going to extrapolate to bring about one of the theories we have discussed and hinted in previous videos, and you should walk away with better and clearer understanding of what's going on. However, before we begin, let me make the disclosure that I am not a financial analyst or advisor, and that all contents discussed in this video are provided as opinions. All efforts are placed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Everything presented is evidence I collect, and all opinions are based on research, experience and knowledge on the matter. I want to thank all my Patreons and one-time donors who continue to carry this channel. With that out of the way, let's hop right into the good stuff. First and foremost today, ladies and gentlemen, let us first address the big news. The U.S. Securities and Exchange Commission, along with other financial regulatory bodies such as the DTCC and FNRA, as well as the notorious and nefarious Robinhood, along with a number of hedge funds including Citadel Securities and their Citadel Connect, are all being sued. They were caught by a surprise lawsuit in the Florida Southern District Court. The reason for the suit is for the selling of counterfeit shares. Information of this came out today that the lawsuit is basing itself under the RICO Act, or the Racketeer Influenced and Corruption Organizations Act. This statute focuses on illegal business activity. I had heard about someone bringing this up to court a while back but never really looked into it. Today I was met with this topic trending in the communities and I could not be happier. We are officially in motion, and I hope this legal proceeding keeps going on. The plaintiff, the man of the hour, Donahue George, served in the United States Marine Corps, so I have full confidence that this crayon-eating veteran is the hero we need at this moment. As you can see, the lawsuit also names Ken Griffin as a defendant. I hope this case goes somewhere and we can at least get some vital information of what is happening. I am glad this is being taken serious by someone that is willing to fight it out in the courts for the rest of us. About time someone showed some backbone on the legal system. Big shout out to George. The man is an absolute legend and I hope he gives them pure hell. And now for the main segment. One of the main concepts we have come to learn through our endless investigations is that the world runs on the backs and general acceptance of quite a small handful of corporations. We know that these small group actually have the power to act as jury, judge and executioner. They have enjoyed and thrived a growing absolute power over markets across the world, and this has given them leverage to decide who wins, who makes it and who gets cut off short. We know this to be true because we have seen case studies about the ever-increasing treachery done by market participants. They have turned lucrative markets into full casinos, taking bets based on companies on whether they will exhaust them out of money or they will keep them afloat until they turn a profit. It has become less about investment and more about manipulating the economy to their own pockets. We have talked about derivatives a lot recently. We also brought up swaps, I believe, on our last Sunday video where we had two sets of DD drops. Today, I want to combine these two sets of information and research and transform them into one. As such, I will go over the most basic facts and terms and then build up my theory, which I have explained before without much evidence. Then I will bring it all back to GameStop and AMC. I recommend watching the other videos, but you do not need to watch those as I made this segment from the perception you know nothing. Let's get started. What is a derivative? A derivative is a financial contract whose value is dependent on an underlying asset. Examples of derivatives are futures, options and swaps. We have talked to death options and how they manipulate them to hide positions and naked shorting. Let's talk about swaps now. A swap is very much what it sounds like. It is a derivative contract, or an agreement to exchange cash flows or liabilities. Now, I want you to focus on that last word, liabilities. A swap of liabilities. This is an exchange of debt-related interest rates. Perfect. We have the most common definitions laid out. Now, let's dive a little deeper. One of the most prevalent theories and topics discussed in between researchers is that of credit default swap. This is a derivative that allows a party to swap a credit risk with another party. Think of it as insurance. A credit default swap is a derivative that provides the buyer with protection against default. Whoever buys the swap will make periodic payments to the seller until the credit maturity dates. In the policy or contract agreement, the seller of the swaps commits themselves to if the debt issuer defaults, the seller will pay the buyer all premiums and interests that would have been paid up to the date of maturity. This was a big deal and major player during the economic recession of 2008. Banks got off the hook, and nothing really changed. Because of that, we are once again discussing this as the driving force which has led us to where we are. Let me cover one more point and I will start putting it all together. One of the greatest weapons Wall Street has is that they see each other as extreme competitors, and will take positions against each other if they can control and manipulate certain things or characteristics of a company. Let me break this down a little more. If I see that my associate took risk by providing a loan for a company, which he then performed a credit default swap with another associate in order to offset his risk, I can come and actually start placing bets. I can go and print naked shares with another person to dip the price of that particular company, which will further exacerbate and make the rebound of the company a lot more difficult. I can essentially manipulate the situation in almost every area and start taking bets against such company because I am so sure that I will collapse that company. I can print naked shorts and even go as far as taking credit default swaps using the same asset for the company. This has worked for years. It worked for me for Toys R Us and I have no history of it ever going bad. However, as life goes, a bunch of low IQ individuals came and started putting money towards that company and purchasing its products. They have been able to generate higher revenue and have actually made all payments on the loan that my associate gave them. I am now in trouble. I have a crap ton of positions I took out. I made a bet which I lost. But it isn't just about losing. It is the fact that, as we have discussed on this channel, I was so sure of my power to control outcomes, that I overleveraged myself. I didn't put $10 out of my $100 bank account. I placed bets that were thousands of dollars, money I don't even have. Only thing I can do is to further continue manipulating the price through routing orders to dark pools, through printing fake shares, through playing with options, with the hope of raising enough cash short term and boring out people from the store so that the value of each of its stock goes down. I have a huge pipe dream that I cannot live up to, because I am no longer in control. I print so much but I do not own the float. I cannot even attempt to own the float because if I start buying, I will cause the price to start running and get margin called. This is what is happening. I took credit default swap positions out of thinking I could control outcomes, and instead ended up getting railed by reality as the company did manage to make a turnaround. The more the price of the TOR goes down, the more it implies I have risked of my assets to manipulate it. It means I am putting even more on it, overleveraging myself each day a little more. Hey, I am so overleveraged that I will not exist if this erupts, so why stop now? I only have a pipe dream of tiring these supporters into other stocks and it's all I can hope for. Might as well keep going. All in all, hedge fund and friends, which I highly suspect are all members of MEMX, took positions to short GameStop. By taking positions, I mean placing puts as well as doing credit default swaps. Once GameStop turned around, it's been chaos as to how to hide this position to not force a squeeze. Hope this explanation was helpful. I got linked a post by a scalpel jockey 9965 who inspired me to put those two theories I have talked about in the past together. Much of what he said fits exactly with what I have mentioning the past 2 weeks but without a full explanation. Now, let's talk about today. The Fed reported that reverse repo operations for today resulted in over $1.109 trillion, which is not as big of a reverse repo operation as yesterday, but still incredibly high. AMC's dark pool transactions accounted for 61% of the total volume, while GameStop dark pool transactions accounted for 48% of the total volume today. According to Fidelity data, buy order flow for AMC were twice as big as the sell order flow, with GameStop's buy order flow being almost 6 times as big as the sell order flow. Now, let us finish up with a recap of today's performance. Big shout out to you for explaining it and allowing me to be inspired to further break it down a little more for the apes, jockey. AMC had a really rough day, experiencing over 7% in losses today. The stock had a dip on the pre-market and was trading incredibly weak. Upon market opening, the stock had a small brief run-up before getting hit hard and falling down. It entered a bearish wedge which took it almost to 34.25. The stock then managed to break out of there only to enter an ascending triangle. AMC managed to make it towards the very end of the pattern, which means whatever happened next was going to be extremely explosive. The stock ended up breaking support and falling back down to 33.33. It consolidated a bit and managed to close at 33.82, well below the VWAP. As for what to expect tomorrow, I have a weird feeling. The stock's next support is at 32.71. If it breaks that, it will have some support at 31.88. If AMC manages to bounce up, it will test the resistance wall at 34.63. If it breaks that, it could hit 36 again. However, knowing that tomorrow is Friday and hedge funds want to dip this stock below 30 to have less options expire in the money, expect anything and everything. Right now, we are way oversold, which should see us bounce up, but given the overall market circumstances plus hedge fund intentions, this means little to nothing. As for GameStop, it also had a rough day, losing over 2% today. The stock traded sideways upon market opening, fighting resistance at the VWAP. The stock eventually ran above it, but for a small and brief period of time. It continued trading sideways up until it was hit with a short ladder attack. GME then fell back down to 150. Eventually, after a small period of consolidation, GME bounced up and closed at 152.90, well below the VWAP. As for what to expect tomorrow, if GameStop continues to fall, it will test 150 again and possibly break that support. It will then hit 147, 145 and 141 if things get really red. These prices represent small support walls for the stock. If GME manages to bounce up, it will find resistance at 154 and 157 for the most part. I think hedge funds want this stock below 155, but getting it below 150 would be a really good outcome for them, though for us as well since it means cheaper tendies. And with that, I want to thank you for sticking around if you are still here. Let me know if you found the video helpful. I try to break things down as much as possible for you guys, but I want your opinion and feedback to keep making this content as easy and accessible for you. I hope this content brought you a little bit of clarity into what is happening across the market overall. Please drop a like on the video if you want to help the channel. A big shout out to all the Patreons and one-time donators, whose contributions have carried this channel and everyone who watches it. Links will be in the description if you want to become an active member and help support this channel. Remember to follow me on Twitter if you haven't already, and I hope to see you guys on the next one. To the moon.